Hey guys, show me math this here, and you're in for a treat today, cause we're gonna go over the 5 top investments that reduce your taxes. And it's not just reduction of taxes. It could also be creating tax-free income, tax-preferred types of income in having tax-free growth. And so we're gonna dive on in and go over them. What I'm gonna do is go over really 3 areas that, we're gonna talk about here that involve tax savings. The number 1 is going to be that you get a black. Is that you? Is that the investment reduces your current taxes? So if you get a checkbox here, it's gonna reduce your current taxes that you owe right now. So there's gonna be a column just gonna make. I'll just do it like this 1, 2, 3. You'll be able to see that. And the number 1 column is gonna be that it reduces your current tax. You'll see, I'm gonna make a little chart up here. And we're gonna be able to go through them, see which areas of tax benefit they're gonna give you. So number 1 reduces your current taxes. How about no 2? Which is you pay no tax on the income generated. In other words, the money that is kicking off is either gonna be tax preferred or tax free. So I'm gonna go over each type of my top 5, and we're gonna see which ones actually create income that's tax-free income that is highly sought after, by the way. And then the last column is gonna be, you guessed it, tax-free growth. Alright. So do they grow tax-free? Can we compound inside these vehicles, or by investing in these vehicles, and end up with a whole bunch of money at the end of the day without having to pay tax as we go? Cause your compounding is much more efficient when you're not having a tax bleed off. It's not taking it away. So let's jump in. I'm gonna go over number 1. And I'm just gonna make little columns here, so you'll see 1, 2. Look, I can't draw a straight line 3, 4. And I guess whatever, let's make a big old chart. This will be fun, boy. This one stinks. Let me make a straight line. There it goes. Alright, so number 1. What's number 1? Favorite is real estate. And there's a number of reasons why. Can real estate actually reduce your taxes when you buy it? I'm just gonna put a little green check mark here, because the answer is yes. How does it do it? Number 1, you could be investing in short-term rentals. It's 7 days or less average use. The losses on that aren't considered passive. They're not rental losses that create passive losses. They could be ordinary loss. There's a step you have to take called material participation, but if you're running your Airbnb, Vrbo, whatever, you're gonna qualify more than likely. There's 7 ways to qualify that property, the depreciation off of that property. If you don't know what depreciation is, a bunch of videos on real estate tax. But it's basically the structure itself gets written off as a deduction over its useful life. And you can accelerate that right off. A whole bunch of it near 1 if you want. But that short-term rental paper loss can offset your other income. Number 2 is you could be an active participant in your rental properties. So if you're active, you get a $25,000 loss allocation. You can get up to $25,000. Now, there's a phase out. If you are over $100,000 of gross income to 150, you'll only get part of that. But you still can end up with just buying a regular rental property. You might be surprised that you're actually able to offset some of your income, especially you guys. If you're in the $80,000, $90,000 range, maybe you're here. Here's a good one. You're married, filing jointly to, in over $120,000. You take your standard deduction. You're gonna qualify, and all of a sudden, you're gonna. Let's say it's a $10,000 loss that you're able to take on your tax return. It's not. You actually lost money. You bought a property. The depreciation created a paper loss, and it's putting money back in your pockets. It's as though you paid $10,000 less than what you actually made. So we actually like that. So those are 2. And then there's real estate professional. If you ever meet somebody who says I make hundreds of thousands of dollars a year, and I pay 0 tax, chances are they're real estate investor. Chances are they're real estate professional. They qualify under 4.69C7 as real estate professional. It's a topic for another day, but we unlock those losses, and we can offset, literally an insane amount of our income just by buying more real estate back. The old joke in the accounting world is if you're paying taxes, it's 'cause you don't own enough real estate. Number 2 does, you can. You avoid pay, yeah. What's it look better? Pay no tax, well, yeah, absolutely. 'Cause you get that thing called depreciation. The depreciation is going to make it so that your income, give it a big old check mark. That depreciation is going to offset the income that's making. So, if you're making rents, for example, and you're taking a deduction for the value of the building, you're literally writing that off, sometimes over 27.5 years. Sometimes over 39. If you're smart and you listen to this channel, you probably know you can do 5, 7 and 15 years and accelerate it all into year 1 if you really want to. With accelerated appreciation, 1.68 thousand, taking bonus appreciation, we can get a massive amount of deduction and it didn't cost us money. It's paper, so it's offsetting the income that's being generated. So if you make $20,000 a year in rents and you have $20,000 a year of depreciation, you pay 0 tax, even though you have the 20. Even though it's in your bank account, you pay no tax. Now how about tax-free growth? I'm gonna give this one a check mark too. That's why we love real estate. That's why it's number 1. It's checking off each box because we can do what's called a 1031 exchange. And we get a step up and basis when we pass. Let's go through those. I can buy property. Let's say bought 3 houses and rental properties, all for $200,000. So it's a total of 600 grand. Let's say over the years, those properties go up in value. So let's say 10 years later, I'm looking at those properties. Gonna man, I've them each for 200 grand. Now, they're worth 400. All right. And I sell those. I sell them for $1.2 million, but I use a 1031 exchange, and I buy another property. Maybe it's an apartment building, duplex, 8plex, and I buy another property, 1.2, and it goes up in value to 3 million, and I sell that, and I buy 2 properties that are, commercial properties. Let's say that it goes up, and it's worth 3 million bucks, right? And then those ones go up in value to 6 million. And then those ones go up to 10 million. And after 30, 40 years, I'm sitting on this little real estate portfolio that's worth 15 million bucks. When I passed away, the basis steps up to 15 million. My heirs pay 0 tax on the sale of those properties. That's why you do step ups. 1031 exchange allows you to continue to exchange those properties forward and buy new properties. As long as it's the same price or more, you're gonna be able to do that. And yes, it could be multiple properties. You could sell multiple properties and buy one. You can sell one and buy multiple properties as long as it's real estate. You can do that. And that's why it gets a big old check mark there. How about no 2? Number 2 is oil and gas. Now, here's the funny thing with oil and gas. When you buy oil and gas, there's something called intangible drilling cost. And I'm gonna give this a check. Oops, I'm gonna make you a green check because those intangible drilling cost IDC are treated as ordinary loss in English. What does that mean? It means if I invest, I just did this. I put a couple $100,000 last year into a series of wells. I received in exchange when my first year, K1 was over $150,000 in loss. What does that mean? I means I invested, but I get this huge amount of loss. Sometimes it's 85%. So I put $100,000, and let's just use this example and you get it. Let's say it's a $80,000 loss. I use that $80,000 to offset other income. It's not passive, it's not capital gain. It is. And it can offset my W to income, and I get a deduction for whatever that intangible drilling cost. It's usually between 70 and 85% of the value of whatever your investment is, depending on what you're doing. It's 100% deductible, and it's absolutely potent when you're investing because let's just say I invested $100,000 into something. Maybe it's $50,000. I'll use 50. Say it's 80, so it's 40,000. And I'm in the highest bracket. I'm in California. You're getting a big chunk. You're getting 37% plus your state on the deduction on some of those things. It could be very, very potent. You always got to check the state. Make sure it comports with the federal. But you get this big old loss as an ordinary loss, which means you get money in your pocket, 'cause you're not having to pay tax on that from other sources. Like you can wipe out your W-2 income. How about paying tax on the income now? You do pay tax on the income that it generates, but I'm still gonna get out of a check mark because you have what's called depletion. So you're only having to pay tax on 85% of the revenue that it produces. When you're selling the oil, you are actually getting that money. That's how the oil wells work, is you get this big fat deduction, and then they're generating oil, and they're selling oil, and they're paying you out. Usually takes you 5 to 7 years to get 100% of your money back. And then after that, it's gravy. It's literally could be 10, 15 years of extra payments. My experience is you're usually looking at between a 7 and a 10% return when it's all said and done. But the big value is when you invest. It's gonna give you a huge tax deduction, a tax-free growth. I'm not gonna give it a check on that, so I'm just gonna give that a blank because it's just kicking you out income. It never stops, right? We're not getting out of that oil well unless you sell the land or something like that. But realistically, when you're just an investor, we're not getting into that. We're not getting into that deep. I'm not gonna tell you that. It's gonna give you a huge deduction. Number 3. Let's get into no. 3 right. Traditional. Retirement. And what I'm talking about here is your IRAs, your DB plan, which I'll go over, your 401k, your different types of retirement plans. It could be a RAF. It could be a RAF. IRA. It could be a RAF. 401k, but we have different types of if you're not familiar with the DB plan, I did a video on how to write out for how to put over $100,000 a year into your retirement plan. That's a DD plan. I have plans that my clients are doing that where they're putting $300,000 a year, tax deductible, 400, 500. Have one guy just going over $700,000 a year into a retirement plan. Yes. Tax deductible. It's reverse calculations based off of how much you've been making, how much you expect to make, and how old you are in. An actuary who's licensed with the IRS gets to do the assumptions, gets to make here's what the numbers are, here's how much you could put away, but you could put away an obscene amount of money in a DB plan. And here's the beautiful part. When you're doing a traditional plan other than Roth, you get a deduction. So with a typical IRA, for example, you might get $7,000 a year, plus you get a makeup if you're over 50. If you're trying to do a DB, it could be, it could be 50,000. That's where they really start to be worth it to probably about 1 million. I've never seen one get quite that high, but it's in that range where you're getting what, that I've heard some that were that big. But you're older, and you've been making a big chunk of money, and all of a sudden you realize I'm behind the 8 ball as far as my estate plan or my retirement planning is concerned, and I need to fund my retirement plan. You could be getting a couple years. Few years to get, you might be able to get up there. If you're doing a 401k, we're looking at $69,000 a year per plan. Like, you can have multiple 401k plans, and you could go up to $69,000 in each. So if you have 2 employers in your high income, you may have your home business, and you're doing stuff on the side with somebody else. Yes, you could actually have 2 401ks. If you're in that boat though, I'm probably looking at DB plans. Pretty strong, means you're making a ton of money. But 69000 plus, there's makeup provisions. And the only thing is that, this is, except Ross, you don't get a deduction when you put money into a Ross. So, those ones, have other benefits. You don't get the deduction when you put a Roth in, but then you never pay a tax on the growth or the income that it generates. So let's do number 2. Number 2. I'm gonna give it a check, but I'm gonna do a check minus. Because the traditional, you don't get the benefit. Traditional plans equals pay tax as it comes out. But with the Roth, you pay no tax when it comes out, and you could have $1 million, $2 million, $3 million. There's actually Peter Thiel has, like, $4 billion in his Roth. Never gonna pay tax on any of its growth. Never gonna pay tax to any of the money that comes out. I just wanna plant a seed. If you are starting out, like you're a low income taxpayer, like, I low the standard deduction. You're, 16, 17, teen, probably about 24. You might be in this range, and you're not paying tax. Get a Roth. 'Cause if you put money in there, you never pay tax going in, and then you'll never pay tax on any of its growth, and you'll never pay any tax. So you could literally make millions of dollars in this thing for paying 1 red cent in tax. So, and if you have kids and you're paying for it, like, let's say you're paying for their schooling or whatever else, but you can get them involved in your business. Maybe it's real estate business. Maybe it's a side gig or whatever. Get them involved in your business to where you're paying them and funding a Roth. If they're under 18, you don't have to do withholdings and employment taxes. There's ways around just about everything. So if again, there's all sorts of fun stuff. I think I've done videos on how to employ your kids too. But, it ends up working. And then all of them get this guy. All get tax-free growth. All growth in retirement plans is tax-free. So you can get in there. You could do crypto. You can do stock. You can be doing covered calls and doing all sorts of fun stuff. You can even be buying real estate in it. A self-directed IRA or self-directed 401k. You could be, doing all sorts of different investments, and at the end of the day, they all grow tax-free inside the plan. The only time you pay tax on a traditional plan is when it comes out. You have to start taking requirement minimum distributions. If you're in a Roth, you never have to pay. That's why they are so potent. Number 4. Hope you guys are liking these. If you like these thus far, just give us a little like, and maybe share it and subscribe. Just do something. So the algorithm says, hey, these guys like it. This would be charities, which is a 501c3 or a donor advised fund. All of these get the same attribute. And by the way, you can set up your own charity. You can ABS, like, there's all sorts of fun stuff you could do with charities. It could be, sports. It could be education. It could be feeding people. It could be a church. It could be, amateur sports teams. I have a sanctioning body here in Las Vegas for multi-boxing and stuff like that. It could be low-income housing. It could be transitional housing. It could be assisted living. All those things qualify, and what we like about it is you get a deduction when it comes in. And it could be a massive deduction. If you're doing cash contributions into retirement plan, a public charity, this could be up to 60% of your AUGI. So everybody that's got high W2. So this is to all you guys, all my doctors out there. You guys that are crushing it as a surgeon or something. You're like, my accountant said I can't do anything. Yes, you can set up a charity. You fund it. You push money in there. It's offsetting your tax. You get a tax deduction. But what am I gonna do with it? Invest it. Put it in a donor advice fund. I got one. You could do it there, right? All you gotta do is just sit there, manage the money, and let it grow. And eventually, it's gonna go to a 501c3. Hint could be your 501c3 if you do it with a group like us. If you go through like a Fidelity or others, it's gonna be a list that you could be donating. Maybe it's your favorite organizations, anyway. But you could be putting the money in there, taking a deduction now, growing it inside the donor advice fund or the charity. If you have a 501c3 again, it could be investing in things for those you guys who think I'm crazy. IKEA is a flipping charity. Harvard is a charity. Major League Baseball is a charity. The Green Bay Packers are charity. All these things are 501c3s. There's lots of different ways to set them up, but the beautiful part is that those investments compound, tax-free. You never pay tax on them if they're in the charity. So, there's great examples. The Hershey Charitable Fund, where they have the Hershey School. That thing's worth like $13 billion now. Set it up in 1905, I think it was. And Milton Hershey and his wife didn't have kids. And this is where they put their money, and just keeps compounding. Just keeps getting bigger and bigger and bigger. So these things are really effective tools. So I love the charity side, but you get a massive deduction if it's a private foundation where you set it up for your family and just giving away money to other charities. You can go up to 30% of your just a gross income. And again, there's so many different flavors of these. I think we did a video. I did a video with Kareem Hanif in our offices. He was an IRS attorney for the exempt divisions and did that stuff for years and works where it works with us. We did, I think, our top 10 ideas for charities or top 10 types of charities. So check that out. If that's tickling your fancy, pay no tax when the income's generated or when it's coming out. Pay note on the income that it actually pays you out. You do pay tax here. You pay tax on salary only, so if you take it out as a salary, otherwise no tax on growth. This is a big one. If the charity keeps the money, so if you set up a foundation and its sole purpose is to grow its income and then distribute it to other charities, those distributions are never taxable. You never pay tax. So all that growth, if it's going out, maybe you have your favorite, pet shelter. Whatever you have, you know what? I'm gonna get 5% a year to that pet shelter. That's the textbook, private foundation where all you're doing is managing the money, growing and growing, and is giving it to places. If that's you, or maybe it's your church, if that's you, these things are great tools. 'Cause you could get a nice deduction going in, and then it grows and grows, and grows, and you can do your giving instead of coming out of your pocket. Let it come out of your private foundation. It's not paying taxes. You get a lot more bang for your buck that way. And then number 3, tax-free growth, 100%. There's, if it gets too big, forget. There's Harvard, I think now has a Congress had a massive charity tax. It's like a 1% or something like that. If you have too much, in your endowments. But for us mortals, there's no tax. So it ends up working out really great. Number 5. This is what I call the triple threat. You ready? Health savings account? Because this will check each box. Boom, boom, boom. And it's really simple. A health savings account allows you to put, it's between about $4,000 and $8,000 a year, tax deductible into a plan, as long as you use the money for health expenses, 0% tax. None, 0. You get a deduction going in, you pay nothing coming out. There's nothing quite like it on this list. I get a deduction, it's limited. It depends on whether it's family or single. I have to have a high deductible plan, which most of us do, and boom, I can get a deduction. So I could put, let's say, I put $5,000 a year into this thing. And it grows and grows and grows. It can reimburse you for all of your medical expenses you incur, even if it's from previous years, so long as the plan existed. So once you establish this plan, and SHA, which you could do anywhere, just go to Fidelity. That's what I did. Or you go to Schwab or anything. They all have SHAs. I set up in SHA, I put $5,000 in, get a $5,000 deduction. So I save on taxes, and it grows and grows and grows and grows. In the meantime, I have copays, deductibles, things that aren't covered for health and stuff. And I start to keep track of it, and that gets to be big. Eventually, the Shah, let's say again, I want $5,000 in that. That 5,000 turns into 10,000. Let's say in 7 years, I could pay the entire $10,000 out to myself and cover all the expenses I had during those 7 years. Guess how much tax I pay? Zero. I got a deduction and I didn't have to pay tax when it comes out. That's why they call it the triple threat and the growth 100% tax-free. So let's say that I open one of these up. I'll just use me as an example. So I did one at a Fidelity. What do I do with it? I do covered calls. I did, just do basic stuff inside of it. I buy stocks that are income producers. So I love my dividend kings and things like that. They're always paying out dividends. I got a deduction when I put the money in. And those accounts are just getting bigger and bigger. All I have to do eventually is use that money to cover my health expenses, and I never pay tax. If you can't, and you say, oh, shoot, then it is possible after a certain age to roll it into a Roth. Believe it or not, it can actually, I think it's 64, 65. If it gets too big, and it's sitting there, and you're like, oh, shoot, I don't have enough medical expenses, which was said by nobody ever. Right, like, nobody says that. But if you were in that situation, there is the possibility to convert it over into a Roth. So these are again, super effective tools. So there's a triple threat on that screen. So those are my top 5 guys. Real estate, oil and gas, traditional retirement plans, charities, donor-advised funds, your 501c3s, and SHAs. And those are the top 5. Hope you got something out of it. Share this with folks if you think that they would benefit from it. And let me know your favorite strategy of the top 5 down below in the comments. And I'll see you later. Hey, guys! We like to learn about land trust, LLCs, corporations, tax planning, even estate planning. We teach a live event every week called Tap Tax at Asset Protection. All you have to do is type in tap below, and comments will send you free information how you can get access and attend absolutely free. Foundation, it's not paying taxes. You get a lot more bang for your buck that way. And then number 3, tax-free growth, 100%. There's, if it gets too big, forget. There's like, Harvard, I think now has a Congress had a massive charity tax. Like, it's like a 1% or something like that. If you have too much, in your endowments. But for us mortals, there's no tax. So it ends up working out really great. Number 5. This is what I call the triple threat. You ready? Health savings account? Because this will check each box. Boom. 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 And it's really simple. A health savings account allows you to put, it's between about $4,000 and $8,000 a year, tax deductible into a plan, as long as you use the money for health expenses, 0% tax. None. 0. You get a deduction going in, you pay nothing coming out. There's nothing quite like it on this list. I get a deduction, it's limited. It depends on whether it's family or single. I have to have a high deductible plan, which most of us do, and boom, I can get a deduction. So I could put, let's say, I put $5,000 a year into this thing. And it grows and grows and grows. It can reimburse you for all of your medical expenses you incur, even if it's from previous years, so long as the plan existed. So once you establish this plan, and SHA, which you could do anywhere, just go to Fidelity. That's what I did. Or you go to Schwab or anything. They all have SHAs. I set up in SHA, I put $5,000 in, get a $5,000 deduction. So I save on taxes, and it grows and grows and grows and grows. In the meantime, I have copays, deductibles, things that aren't covered for health and stuff. And I start to keep track of it, and that gets to be big. Eventually, the SHA, let's say again, I want $5,000 in that. That 5,000 turns into 10,000. Let's say in 7 years, I could pay the entire $10,000 out to myself and cover all the expenses I had during those 7 years. Guess how much tax I pay? Zero. I got a deduction and I didn't have to pay tax when it comes out. That's why they call it the triple threat and the growth 100% tax-free. So let's say that I open one of these up. I'll just use me as an example. So I did one at a Fidelity. What do I do with it? I do covered calls. I did, just do basic stuff inside of it. I buy stocks that are income producers. So I love my dividend kings and things like that. They're always paying out dividends. I got a deduction when I put the money in. And those accounts are just getting bigger and bigger. All I have to do eventually is use that money to cover my health expenses, and I never pay tax. If you can't, and you say, oh, shoot, then it is possible after a certain age to roll it into a Roth. Believe it or not, it can actually, I think it's 64, 65. If it gets too big, and it's sitting there, and you're like, oh, shoot, I don't have enough medical expenses, which was said by nobody ever. Right, like, nobody says that. But if you were in that situation, there is the possibility to convert it over into a Roth. So these are again, super effective tools. So there's a triple threat on that screen. So those are my top 5 guys. Real estate, oil and gas, traditional retirement plans, charities, donor-advised funds, your 501c3s, and SHAs. And those are the top 5. Hope you got something out of it. Share this with folks if you think that they would benefit from it. And let me know your favorite strategy of the top 5 down below in the comments. And I'll see you later. Hey, guys! We like to learn about land trust, LLCs, corporations, tax planning, even estate planning. We teach a live event every week called Tap Tax It Asset Protection. All you have to do is type in tap below, and comments will send you free information how you can get access and attend absolutely free.